and we looked at specifically two sources, which is the cost of common stock, and we said when we are computing the cost of common stock, we want to get the minimum return on the common stock that we should generate. How do we get that minimum return? We said we have two models that we use to determine the minimum return. You can use the dividend model. You can use the capital asset pricing model. That's what we said. In the dividend model, of course, you need to estimate the dividend growth or the dividend that you are going to pay. In the capital asset pricing model, you are recognizing the risks. That's the systematic risk, because we say that unsystematic risks are constant. So you only look at to estimate the systematic risks. That is what we looked at in that aspect. Now, I want us to continue and look at cost of debt. Cost of debt. Now, when it comes to the cost of debt, of course, it is the minimum return that need to be generated debt capital. If you are financing a business with debt, what is the minimum return that you should generate on the debt capital? That's what we call a cost of debt. So debts are classified into two major categories. Debts are classified into two major categories. Now we have number one, untraded debt. Traded, sometimes called unfloated debts. And number two, we have the traded or the floated. The floated debts. These are the two major categories of debts. From here, you can have different types of debts. So if you come to the first one, untraded, or sometimes we call it unfloated. Unfloated debts. Now, what do we mean by these types of debts? These are debts which are not traded in the market. So those debts which are not traded in the market or in the capital market, or they are what called the untraded or unfloated debts. So these are debts which are not tradable or traded in the capital market. That's what's called for example here we have the bank loan. A bank loan, we don't float it on the market. It's just under OTC, or they are traded under OTC. They are negotiable. OTC meaning over the counter. They are traded over the counter. So these are negotiable instruments. Now, when it comes to these types of
What do you mean by over-the-counter lecturer?
Yes?
What do you mean by over-the-counter?
That they are negotiated through financial instruments. That's what I mean they are over the counter. You negotiate them through a financial institution.
Okay.
Yeah, that's what I mean by they are OTCs. They are traded over the counter. So, for example, we have this bank loan. A bank loan, it's not traded in the market. It's just negotiated through a financial institutions. So these debts are just negotiated through financial institutions. So you cannot have the market price for these debts. So these are so they don't have a market price. So how do you determine the cost of these debts? Cost of untraded debts. How do you get the cost of these untraded debts? I don't know the abbreviation I should use. The cost of untraded debt. Maybe I can use that. If the debt is not traded and you are using that debt to finance your operation, how do you determine the debt, the cost of these debts? First, these debts, they don't have market price. Now, when you are looking at the cost of untraded debts, our KUD is going to be equal to the interest rate you are charging on the debt, or the interest rate you are paying on the debt, into 1 minus T, where I is the interest rate on the debt, and the T is the corporate tax. Because the reason for subtracting tax is because the interest on the debt is tax allowable. So part of the cost is paid by the government, and the part of the cost is the one you pay in business. So let's say maybe a simple example that company X is financing its operations using 10% bank loan. The corporate tax is 30%. So compute the cost of the loan. So a loan is untradable. You cannot float the debt in the capital market. They are just negotiated over the counter. So you cannot have a market price that you are going to get it, because the cost should be based on the market price and the return you are getting. But because you don't have a market price for the loan, when you are computing the cost, you just get interest into 1 minus tax. Then you are going to get the cost of that loan. Now, if I'm to look at the data we have, we have our interest rate I as 10%. We have the corporate tax T, which is T, as 30%. Now, do I have all my, if I substitute into my formula, how do I get the cost of this loan? This is a, maybe I can, cost of the loan will be equal to the interest into 1 minus t. Do I have all the variables to substitute? The answer is yes. So I will be 0.1 into 1 minus 0.3. 0.3. And I'm going to get 0.07, which is the same as 7%. So that is going to be the cost of this loan. If you are to, it means you should generate a return that is equivalent to 7%. If you are to motivate the loan, that's the minimum, the loan holders to finance the business. So that if, as long as you are dealing with untraded, you just get the interest into 1 minus t to calculate your cost of that debt. Now, another one is what we call the traded debts or floated debts. Sometimes we call them loan stocks. These are debts which are tradable, which are traded, or which are floated in the market. These are debts which are traded in the capital markets. So what you will find with these debts, you'll find that these debts, they have a market price. So this can be classified. Of course, we shall look at other classification, talk about the sources of finance, but for the time being, we're only going to deal with the 3 categories of these debts. Of course, you have also a zero coupon, which is almost the same. So we have irredeemable debt. That's number 1. Irredeemable debt or irredeemable loan stock. Then we have number 2, redeemable debt. Sometimes we can say redeemable loan stock. 3, we have convertible debt, and sometimes you can have a zero coupon. We shall talk about this zero coupon. A zero coupon debt or a zero coupon loan stock. So these are the different types of debts, but we should still again look at more details of these types of debts when we are talking about the sources of finance. Now, if I can start with the first one, and then we discuss it, irredeemable debt. Now, when it comes to irredeemable debt, or maybe before we talk about this, sorry, let me first talk about some of the key terms used in debt financing. Maybe first understand the key terms, because we may need key terms used in debt financing. Before we look at those types, I want to first look at this. Some of the key terms that we need in the debt financing. Number one, we have what's called a nominal value. Nominal, face, or per value. And the set is the value at which the debt was issued. And this is always in the denomination of 1,000 or 1,000, even if I put 1,000 or hundreds. Debts are always issued with the face value which is in the thousands or in hundreds. Now, I want you to look at this. Sometimes a question may give you the current market price of the debt. If I say the debt is currently trading at 1,100, it means its value, its nominal value is 1,000. If I say the current debt is trading at 98, currently the debt is trading at 98, automatically it means the nominal value of that debt is 100. Or if I say the current debt is trading at 120, it means its value, its face value, even if it is not given, it is 100. Are we there together? Yes? Members?
Yes, we are here,
Yes.
but
May you come back a bit on that 1,000 and 100?
Because sometimes a question can say the debt is currently trading at maybe at 1,050, but you may not be given the market price. I mean the nominal value or the face value. You are given the market price of the debt, 1,050. Automatically it means that debt is in 1,000. It has got a face value of 1,000. That is automatic. That's what it means. Even if you are not given that the debt is the face value of debt is 1,000, but as long as you have the market value, if I say the debt is selling at 998, if it is selling at 998, it means it's selling at a discount, but its face value is 1,000. Alternatively, if I say
no,
the debt is selling at
1,000. Excuse me. 998, it is not 1,000, it is 100.
998,
Yes.
no. It's 1,000, but selling at a discount.
Because we have 3 numbers. It is 100.
Yes. Huh? No, it is 1,000. A debt cannot move from 100 and it reaches 900.
What can indicate that is the first value is 1,000?
Because the first value, because can you say that the debt with 100, with the market, with the first value of 100, is the one that's selling at 998?
Yes.
At a premium of 800 something. That maybe if they say it is a junker debt.
Okay.
Yeah. So please look at the values that you have been given. Then from there you can be able to identify, because debts are always in hundreds, they are always in thousands. Then number 2, or what we call B as our key terms, is what we call redeemable value.
Can you scroll up a little bit? Yes. Okay.
Redeemable value. So it is the value at which the debt is paid at maturity. The value at which the debt will be paid at maturity, or the value of the debt at maturity. But that's not the market price, but the value at which you are going to pay that debt at maturity. And the debt can be redeemed in 3 ways. The debt can be redeemed in 3 ways. That is at par, at premium, and at discount. Now, if the debt is redeemed at par, if we say that the debt is redeemed at par, or the debt will be redeemed at par to maturity, because sometimes the question, if the debt is redeemed at par, so it means its face value is equal to the redeemable value. What do we mean here? What we mean here is that if the debt is 1,000, if the par value is 1,000, if par value is 1,000, if that's the face value, it will be redeemed. The redeemable value will also be 1,000. In that case, it means after maybe 3 years or after 4 years, you are going to redeem this debt at its. You're going to redeem this debt at its par value. So in that case, we say the debt is going to be redeemed at par. Now, if we say that the debt is going to be redeemed at a premium, if the debt is redeemed at a premium, is less so if the redeemable value, if the par value maybe is 1,000, redeemable value can be maybe 1,100. So in that case, we say that the redeemable value is going to be greater than the par value of the debt. So in that case, the debt is redeemed at a premium. So you just need to know what is the premium on that debt. Then you add the premium to the face value to get the total value of the redeemable value. Now, another one is when you are redeeming the debt at a discount. So if you're redeeming the debt at a discount, it means In that case, the redeemable value is going to be below the par value. So if the debt, for example, if the par value, if our par value is 1,000, then the redeemable value maybe say 980, something like that. So in that, but it is below 1,000. So in that case, we say that the debt is at a discount. So another term that I want us to talk about is what called that's number C, the conversion value. And it is the value at which the debt is converted at maturity. So if you have a convertible debt, that is a debt that can be converted into shares. If you have a convertible debt, the one which can be converted into shares, you look at what is the value in case this debt is converted into shares. And how do you get that value? Our conversion value is going to be equal to the exercise price or what we call the conversion price times the conversion ratio. And when you say the conversion ratio, it's the number of shares that can be converted from each debt. That's what we call a conversion ratio. How many shares are you going to convert from each debt? So that gives you the conversion ratio. So the conversion ratio is the number of shares that can be converted from each debt. If you have, in that case, you have a conversion ratio. So how do we get this conversion ratio? So conversion ratio is equal to par value divided by the exercise price. The par value of the debt divided by the exercise price. Par value of debt divided by the exercise price, then you can get the conversion ratio. Let's give a simple case, a simple example, and maybe see our company X or company Y has issued a convertible debt with a par value of This should be the market price. With the per value. With the per value of 1,000 and the market price of the share is 200. The exercise price is 150. Then required compute the conversion value. If it is this like this, then you can say, how many shares are you going to get with the current market price? Our conversion ratio, or if I can get the data, the per value, the per value is 1,000. The market price is 200 of the share. The conversion price is 150. So what is going to be the conversion ratio? The conversion ratio would be 1,000 divided by the 200. It means you are getting 5 shares. You are getting 5 shares from each date. You will be given 5 shares. From each date. Then, how much will you get? What will be the suppose you decided to convert your debt? What is going to be the conversion value?
Scroll up a little bit. Yes.
So in this case, it means you'll get 5 shares times.
Scroll up.
I think I made a mistake.
Okay.
Is it okay?
Scroll up.
Hey, what is wrong?
Yes, there.
CPA. So times and the 150 that you are going to get. So you have 7. So in that case, you will not. Hey, mister, what is wrong?
You're too speed. Don't scroll down too much.
So this one we shall discuss again. I was just illustrating what it means, but we are going to discuss them in the sources of finance again. So please, I think we can look at it again in our sources of finance. So we were looking at the terms. These terms we are going to use in our calculations. So we need them to understand them. If we say conversion value, what do you mean by conversion value? So the first we are going to talk about is the cost of irredeemable debt. Cost of irredeemable debt. What is irredeemable debt? When we say irredeemable debt, is a debt without maturity period. Without maturity period, meaning it is in perpetuity. That is, it is perpetual. It has no maturity period. Then we call it irredeemable debt. So irredeemable debt or irredeemable on stock, because sometimes you can say irredeemable on stock, irredeemable debt. We are speaking the same language. Now, how do you get the cost of irredeemable debt? Because irredeemable debt, you are paying interest in a perpetual. So irredeemable debt or loan stock, it has got a perpetual. It has got a perpetual interest. So when you are computing the cost of this debt, maybe you can abbreviate cost of irredeemable debt. When we are computing this cost, as long as the debt has no maturity period, we classify it as irredeemable. So if I'm computing the cost of irredeemable debt, it's going to be equal to the interest. Please mute. Interest into 1 minus t. I divide by the price. I divide by the price of the debt at that period. So where I is the interest is the interest on the debt, which is equal to, how do you get this interest? We get the interest rate on the debt, or the coupon rate, the interest rate times the par value of the debt. I get the interest. I get the interest rate on the debt, then I multiply by the par value, I get the interest on that particular debt. Now, T, we have already defined T.
Excuse me, lecturer.
Yes.
On that correction of conversion value, 750 means what? It means that is the
value at which the debt you can be converted. If you convert,
if you convert in shares.
In shares, that would be the value.
This is the value you will give.
Yes, you will substitute your debt into shares. Now, T is corporate tax. Is corporate tax, and the PO is X interest price. Remember we talked about X div price. Even here, please mute Joseph. Here we talk about an X interest price, the price without considering the interest that you have announced to pay the interest. So if you take another example, I want you to take it slowly, probably here. If you take another example, that company X issued a redeemable debt. Redeemable debt with a par value of 1,000 and the current market price. The current market price of the debt is, let's say, 1,050. So if it is irredeemable, the interest rate or the coupon rate, the interest rate of the debt is maybe 15%. And the corporate tax is 30%. So required, compute the cost of the debt. So if you look at this one, we have a debt without a maturity period. You have a debt which has no maturity period. So in this case, we classify this debt as irredeemable. So if I'm to get data from this question, what's going to be my data? Or I can just start my formula, or I can get the data. So I have a par value already. I have the par value of the debt, which is 1,000. I have the market price, my PO, which is 10.50. I have an interest rate. I have an interest rate on the debt if I can copy my data, which is 15%, and what else do I have? I have tax T, which is 30%. So if I can put my formula here, that this is a cost of a debt that is redeemable, because I have not been given the maturity period. So if I can say that my KID is equal to interest into 1 minus T, then divided by the current price. So what do I have in the data, and what do I need to calculate? That is very important when you're calculating this. What do I have in the data, and what do I need to calculate? I already have, I have the PO, I have the tax. What I'm missing is the interest. And how am I going to get the interest? It's going to be equal to
Per value
the per value, which is 1,000,
times interest rate.
times the interest rate of 15%.
Yeah.
And I think we get 150. Huh? 150. So it means from here, I can be able to substitute. I can be able to substitute in this. So meaning my KID, based on that, will be, because I have all the data now, will be 150 into 1 minus 0.3. Then after that, I divide this by 1,000. What does your calculator say?
Excuse sir.
Yes.
It's not 1,000. It's 1,050.
Which one? 1,050, sorry. $1,050. What does the calculator say? Calculator is saying what? Members, you are delaying.
10%.
0.1.
0.1, which is the same as 10%. So that's going to be the cost of this debt.
Excuse me, sir.
Yes.
Remember, PO is the X interest price.
Yes.
So PO should be equal to 1,050 minus 150.
No, have they told you that this is the company has, because how do we get this? The question is not saying us that the company has declared to pay an interest. It means this interest is already paid. The price is after the interest is paid. If the question had said the company has announced to pay interest on for redeemable, in that case, you would say that is a CHUM price. Are you getting me on that?
Okay.
But in this case, it's not saying that, so we're assuming that is an X interest price.
Okay, understood.
Yes. So that is how we are going to get the cost of a irredeemable debt. Then number 2, which is the cost of redeemable, not irredeemable. Cost of redeemable. Redeemable debt. Maybe you can abbreviate as KRD. RD, cost of redeemable debt. So a redeemable debt is a debt which has got a maturity period. That's what called a redeemable debt. A debt with a maturity period. As long as you issue a debt that is, or a loan stock that has got a maturity period, we call that one redeemable debt. So it is a debt with maturity period. So the cost of redeemable debt is the IRR, internal rate of return. The internal rate of return of the debt at maturity period. Please mute. Or what called the yield to maturity. Yield maturity of the debt. So when it comes to when you are looking for redeemable, we said a redeemable debt is a debt that you are going to pay back, which has got a maturity period. So when you are calculating, when you're looking at the cost, what you are looking at is the IRR of that debt, or sometimes we call it the yield to maturity of the debt. So what is this? How do you get this yield? Remember, when you are getting the IRR, it is a try and error. You are going to interpolate a positive and a negative to be able to get the IRR. I don't know if you are getting me in that case. So what we are saying here, because you are getting IRR, and how do you get the IRR? Remember, we say IRR is equal to A, or A% plus NPV at A over NPV at A minus NPV at B then what I get here, I multiply by B minus A. So I will get NPV. Because you are interpolating this one, we are going to use an interpolation formula to get our internal rate of return, which is A into plus NPV at A over NPV, where sometimes we have different definitions. Maybe we can use the common definition that are already there, where A is the lower rate. Sometimes I use the cost of capital. B is the higher rate. So it means NPV at A, it is the NPV at a lower rate, and NPV at B is the NPV at high rate. Then after that, you can interpolate your IRR, and then the IRR is going to be the cost of a redeemable debt at maturity. I can still give an example to illustrate this. Example, I can give an example again to illustrate this. Company X issued or is financing. Let me use that. Is financing its operations using 15% redeemable loan stock with a par value of 1,000 FRA. The debt is redeemed after 5 years at a premium of 10%. The current market price of the debt is 10.50, and the corporate tax is 30%. Required: compute the cost of the debt. So if you look at this, this question or this simple example that we are looking at, if you look at this simple example, you see that this is a redeemable debt. Why? The debt has got a maturity period, meaning it is going to be redeemed, it's going to be paid back after 5 years. Having the price, it means it is a tradable debt. Having these prices, it is a tradable debt. That's what it means if you're analyzing the question. Now, how do I attempt? I'm going to first get my data from the question. What's the data I have? I have the par value of the debt. That one I have it, which is 1,000. I have the market price of the debt, which is 10.50. I have the redeemable value, my redeemable value of the debt, which is going to be redeemed at premium. It means it is 10% plus 1,000 or 1.1. Are you there? Is it 1.1 times 1,000? Is it true? Yes? Is it true? Umutari kuvuga. We are redeeming the debt at 10%. So it means we are going to redeem it at 110%, which is 1.1. Are you there?
Yes.
It's okay.
Yeah.
Okay. So what else do we have? We have T, which is 30%. I have the coupon rate. The coupon rate or the interest, it means the same. Interest rate. Coupon rate, interest rate, it means the same, 14%. 14%. What else do I have in the question? My N is 5 years. I have the N, which is 5. So now, remember what I need to get because it is a redeemable debt. What I need in this question, I need to get the IRR of this debt. So first, I'm going to get my interest. What is going to be the interest to be paying on the debt every year? Interest. Because we only have 2 cash flows or 3 cash flows. Our interest is going to be equal to our value, as we said, times our coupon rate. Since we have tax, adjust by tax 1 minus t. Because you have tax, you can adjust by tax. So this is going to be equal to 1,000 times 14% times 1 minus 0.3. Because there is
What is Sierra?
Sierra is the coupon rate. Sierra is coupon rate. Is a coupon rate. Coupon rate and the interest, it means the same. But on the bond, you always use the word coupon rate. But it means the same as the interest rate. So, now, what do you get there?
98.
98.
Yes.
This is our interest that we are going to be paying every year for a period of 5 years. You'll be paying that interest. Now, once I have that, I have the interest, I have the market value, I have the par value, I have the redeemable value, I have the N. So what do I need? I need to get to the NPV. So my first part, I'm going to get the NPV of the debt, NPV of the debt, maybe I can write it down here. Okay, let me write it here. I need to get the NPV of the debt because it is a try and error. You can use any. If you're not given in the question, sometimes you can be given in the question the rates you should use. But if you're not given, you can try the rates you can use. I can start with the 14% and see what 14% gives me, and then from there I can change to get another rate. So if I use, what would be the NPV at 14% of this debt? So I have the item here. I have my cash flows here. I can take this one as the period. I have the cash flow. I have the discounting factor, our discounting factor. Then I have the present value. Are you there? So my first item is the market price. My market price, which is going to be in a period 0. Being in a period 0, it's going to be negative. So I copy it as a negative because it is in period 0. Remember here, our discounting factor is at 10, at 14%. That's what we have selected in the first place. Then I have the interest. This is period 0. I have the interest that I'm going to pay from year 1 to year 5. If it accepts, no, it has phased. I need to change and they call this one number. Oh, it's not a number.
Excuse me.
I call it what? Yes, general? No.
5,050 makes a negative.
Huh?
Why you made a negative market price?
Why I call it a negative? It is because it is in period 0. That's the money you are going to invest in the debt.
Okay. It is regarded as an investment.
Yes, that's the money you are investing, the amount you are buying the debt.
Okay.
It is year 1 to year 5. It has refused to year 5. I'm putting like that. From year 1 to year 5, I'm going to pay an interest of 98. That's the interest you are going to have. Then, in year, I have a redeemable value, which I've already calculated, which will be in year 5. In year 5, I have a redeemable value. A redeemable value. So, which is going to be 1,010, 1,100. I hope we are there together.
Excuse again, sir.
Yes, please.
If that is redeemable value,
Yes.
equals to per value plus 10% of
Yes,
premium.
per value plus 10%.
Okay.
Now,
Pardon, sir.
yes, please.
But if the question does not give you a premium
It means you are redeeming it at par.
at par,
Yeah.
so what if it's a negative or it's redeeming it at a discount? Also, you can use a
Yeah,
discount value.
you recognize the discount.
Okay.
So meaning here, what will be in year 0? Because
1.
you still remember the formula we are using. This is a lump sum. Being a lump sum, our discounting factor will be, how do you get the PV? You are using annuity, not annuity. Is it 1?
1 plus interest.
1 plus
Interest.
our interest
Power
minus n.
negative n.
Power minus n. The second one, this is a lump sum. The second one is an annuity, where you have a constant. Being an annuity, it means we are getting 1 minus 1 plus r power minus n
Divided by R.
divided by
R.
r.
So lump sum, you mean what? Lump sum, you mean what?
Lump sum, it means the cash flows are not constant. It means the cash flows are constant. So these are any constant cash flow. Maybe I can. Any constant cash flow. So these are constant cash flows, where you have constant cash flow. So we can now put in here. It is
Excuse me, sir.
plus 0. Yes, 14.
If we come back a bit on that constant cash flow, it is a whole formula divided by R, or it is 1 plus R power minus N over R.
It is the whole formula divided by R.
Okay.
Yes.
And people can mute the disturbance.
Please mute if you are not asking. This is power minus 0. You get that? This one is an annuity. So it will be, wow, 1 minus 1 plus 0.14 power minus 5, isn't it? Divided by 0.14. This one is divided by 0.14. You will accept. Yeah. Yes. That's what I get. So can I copy this? You need to accept copying the formula. It is not hard. So it is 1. I'm just using this upper formula now. Here I've used the annuity. Here I've used the upper formula. I'm using the upper formula. Plus 0.14 power. I've overpressed. Power minus 5. Power minus 5. And I have this. So what will be my present value? It's going to be this times this. And here we have up to this. Doctor. So if you look at this is our NPV. And by using 14%, our NPV is negative. The NPV is negative. So it means I need to lower my rate. If I lower and maybe I use like 8%, I'm going to copy this. Because we need to get a positive and a negative. So I'm copying this. Hope it will carry my formula. So I want to change this. Now I'm going to use 8%. So I'm changing here to 8%. So this one is a 0.08. And this is going to be 0.08. And this, I don't think it has 0.08. And this one also, I change it to, but you can use your table for you. I'm just using an Excel. So what do I get here as NPV? In this case, it didn't carry the minus. Why the minus is missing? See, but it is not coming with the minus. Yes. That's how many cook. I can just take this, I think now. Yeah. So my NPV now is now positive at 8%. I have a positive NPV of 89.9. Now it means now I'm copying the other formula that I need to use to interpolate, because we said we just need to interpolate. So I want to copy this formula and bring it down such that we can use it to interpolate what we are talking about here. So it means our lower rate is 8%. That's the lower rate, 8%. Our higher rate is 14%. If you cannot manage this, because sometimes you need to be very careful with the negative, I just use this one as cost of capital and this one as estimated. But let's use the one maybe you are familiar, which is higher rate and the lower rate. So if I substitute, I'm going to have A, which is 0.08. I hope your calculator has started to calculate, plus 89.9. Your calculator has started, into B, which is 0.14 minus 0.08. And here down, I have 89.9 minus become plus, I think, plus 142.3. What does the calculator say?
That's right.
Our IRR is equal to
Hey. Yeah. Ate edija kitusema gikoze.
What are you getting? I'm not getting your answers.
Sinikira WhatsApp ye.
10.3%.
10.3%. Okay. So that is what it means at that point. That's going to be your cost of that debt. I don't know if you have a question on that, on how to compute the cost of the debt, which is redeemable. Any question, comrades?
Yeah, we can use the tables to get
the value. You can use the tables to get the value. That one is okay.
Okay.
So costs. Cost of convertible debt. If you don't have a question on this,
Kati tumanya amafuta, buli kati kutya amafuta gammenya kati. Ogenda kivuga todi. Ate musiru takusire waza. Ukundi okule na appointment. Vincent.
Someone is disturbing in Luganda.
hey,
Sebo is shouting.
okay, let him reduce a bit.
Okay.
So I don't know if you have a question there. Can we move on?
Yeah, we can move on.
So let's look at the cost of a convertible debt. Now, the cost of a convertible debt, it is similar to a redeemable debt. Only that when it comes to redeemable value, you need to look at the higher of a convertible debt and the higher of the market and the what? And the conversion value. But the way you compute a convertible debt is similar as when you are computing for redeemable. So the cost of a convertible debt, is computed in similar ways to the cost of redeemable. That is IRR of the debt at maturity. Only that for the convertible debt, the redeemable value is the higher of conversion value and the market value at maturity. So the process to compute the cost of a convertible debt is similar. It is similar to that when you are computing the cost of a redeemable debt, except one item that when you are looking at the redeemable value, you are going to take the higher of a conversion value of the debt and the market value, because for conversion value, the investor has got an option to convert. He can convert the debt or may not convert the debt depending on the conversion value. If the conversion value is below the market value, someone is not going to convert. If the market yes,
Is it only for the convertible or only for the redeemable?
no, for convertible, that's when you compare the conversion and the market value.
Okay.
Yes. Can I test you this and you do it? Maybe in 5 minutes. You telling me the answer. Company X issued a convertible debt with a par value of 1,000. The debt is converted into 6 ordinary shares at 200 francs per share. The market value of the debt at maturity is 1,150. The debt is currently trading at 1,100. The coupon rate of the debt is 15%, and the corporate tax is 30% required. Compute the cost of the debt. So can you now do that one? This one in 5 minutes, I think. You have all the data. I want to hear your answers. That's how they are.
Akuja simano ngazisa nchi. Unimo kuuza set balance kwa ina mumpe. Wasikute solo mwende sente napa.
Naweta.
Mana nima lo kasitaka kwa ofisi leta mlapu. Kanofuna otemile emikisa. Mulio kulana. Bantu bali mukaba.
Yeah, they're not good.
Wakasa katonda. Mko ile sema ifola business. tovuka wange zibukako mangu batwalika mmoja alina kumeneka kesi alaye musumbuwa
How far?
mukulu geze
Where are you getting this PO of 110?
It is 1,100.
Yes.
So what are you getting?
ekisajja kikubira ne network egana enkola kikubire kikwate yanya ekimpulira mugeyi muzeeyi age mukubire mugeyi muzeeyi age mukubirako akizako okukubira toyogera mugeyi muzeeyi yakubira neretikazamatomuza yakuwulira.
I'm waiting to hear your answer.
Tell me,
Yes.
where do you get 5 years?
It was what? It is redeemable after what? No period.
Yes.
Oh, I think it remained. Okay, maybe it is missing. Hey, 5 years. I want to hear your answer. So it means here our redeemable value is going to be the higher of these two. It's 1,200. What is the cost? I want to hear.
Excuse me.
Yes.
1,200 is compared with 1,050.
50.
Oh. 1,050.
That's the market value of the data to maturity.
1,000 with the 1,100.
150.
Okay.
I want to hear your answers. Yes, I think the first answer is entered. The first answer is the 150, not 105. Have you multiplied by tax, Felix? Felix, multiply by tax, by the tax benefit. 1 minus 0. Please mute. I see you enjoying.
Joseph goes.
He's enjoying the calculation, I think. I want to hear your final answer, but you are not giving me the answer. Have we got the same answer there? What is wrong, comrades? Hey, comrades, you are not giving me answer. I'm almost reaching my final answer. I'm not getting yours.
We are together.
But I want to hear yours.
Yeah, we are following what you are doing.
I want to hear your answer in the one you have calculated, not following mine. I want to hear what you have got as the answer.
So you mean you want us to lie? You
Not lying me, telling me what you have calculated. Because that's why I'm not saying any word, because I know you are calculating also.
Yes, equals to 0.07.
That's what you have got.
No, calculation. Plus 186 over 186 plus 151. 15 minus 0.07. You are getting 11.4.
That's the IR.
Yes.
Okay, that's okay. If you... So please, that is how we. That's how you calculate the cost. The cost of. So there is no difference in the calculation if you look at this. Only that when it comes to redeemable value, you are going to compare. You are going to compare the higher of conversion value and the market value at maturity. And from there you can select
Have we
the
used
higher.
that value, sir?
Yes?
Have we used that value?
Yes.
Where?
Look at these two values. This one
Yes.
and the one which has produced. They have produced this.
Higher of the two.
Yes.
That is the redeemable value.
Yes. But you take the higher of these two.
Okay.
Excuse me, lecturer.
Yes, please.
Why do we call this 1,150 as a market value?
We expect maybe after 5 years, that's going to be the value of the debt.
That is the market value at maturity.
At maturity.
Okay.
Because when you're evaluating to convert, you are looking at, suppose I'm converting, how much can I convert my debt? And then suppose I'm paid back my money, how much can I get?
What is the role of this current market price?
That's what if you are buying the debt today, that's what you are going to buy.
Mm-hmm.
Yes.
I thought it's per value.
Per value, that's when the value you issue the debt, but it may be selling at a different price in the market. Yeah, but that's its face value. But you find that in the market it is selling at a different value.
Okay.
Any question? Any question, comrades? Okay, so we can move on. So cost of zero coupon. Cost of zero coupon bond or what you call a zero coupon debt. So what is a zero coupon debt? A zero coupon bond is a debt which is issued without a coupon rate, without interest rate. That's what called a zero coupon debt. So it is a debt which is issued without a coupon, or what called interest rate. That's what called a zero coupon. You issue a debt, but the debt has no interest rate. So how would you get the cost? Or what will be the return? So the return on the or zero coupon, the return on the zero coupon is the interest. Is the difference between the par value and the market price. You get the return. The difference between if you issue a coupon debt at 1,000 and it is selling at 1,050, then the difference will give you the return of that coupon, of that bond or that debt, because it has no interest. You cannot calculate interest on it because the debt has no interest. So you only look at the market price. So the return is based on the capital gain on the debt. So the return is based on the capital gain of the debt. So how do you get? You will just get, so I think I can abbreviate as cost of a zero coupon debt. So I will have, it means my cost of a zero coupon debt will be equal to P1 minus P0, then I divide by P0. Simple like that, I get the return on that coupon. That's going to be the cost. So that divided by P1, not P0. Divided by the P1, the current market price. Then you get the return or the cost of the coupon debt.
Why do you divide by P1?
Because you are looking at the current price. What's the price? How much is it selling? Because P1 is the current price. P1 is the current price.
And the P0?
Is the par value. And the P0 is the par value. So this one is not very complicated. So you can be able to calculate it. So that is the cost of a debt. So it depends on the type of debt that you are calculating. Whether you are calculating an floated, or you are calculating a floated. And if the debt is floated, what is it? Redeemable, irredeemable, convertible, or a zero coupon? So it's going to depend on the debt that you are calculating when you are determining the cost of the debt. So in brief, that is what we can say on the cost of debt. But before we summarize this part, I want to add something small, which is called debt rating and cost of debt. I want to add this one, which is debt rating and the cost of debt. So when it comes to debt rating, The debt rating is based on the risk of the debt. The higher the risk, the lower the rating of the debt. The lower the risk, the higher the rating of the debt. So we have got different companies, but the common ones we have the S&P, the Moody, and the FinTech, the one that are dealing in the debt rating. And each of these ones, they have a different method of rating the debt. So debt rating depends, the debt is rated depending on the probability of default. So the debt is rated depending on the probability of default. The higher the probability of default, the lower the rating. The lower the rating, and the vice versa. If you have a debt which has got a high probability of default, it's going to be rated. It's going to be rated lower. If you have a low probability of default, that debt is going to be rated high. It means it has low risk. So the risk in the probability of default, or in the default or loss given default, is measured by what we call the credit spread. The higher the spread, the higher the risk. The lower the spread, the lower the risk. So the risk associated with the probability of default is measured by a credit spread. So the higher the credit spread, the higher the risks, and the vice versa. If a debt has got a high probability of default, it's going to be having a high credit spread, meaning that debt is going to be high risk. So having a high risk, it means it's going to be rated lower compared to the debt with a low spread. So as you have said, I'm not going to enter into the way the debts are rated. We have got different rating methods. That one is not of much importance, the way the debt, because their debts are rated the AA, there are those which are rated AA, depending on the method. We have Moody, we have the FinTech, we have the S&P 500. There are different Bloomberg. There are different companies that do the debt rating. So their rating, most of them they rate basing on the probability of default. If a debt has got a high probability of default, it will be having a high spread, and in that case, you will be having a high risk for that debt.
What does it mean? That's the last sentence. The credit spread, the higher,
The higher the credit spread, the higher the credit spread, the higher the risk, and the vice versa.
Okay.
Yes. So I was saying, we have got different companies. And different companies, for example, you will see others use AA, then you have AA, small a, then A, then you go to B, BB like that. Then if you go to other companies, there are those which use A, small a, then those one they say AA, then A. Others, they use A plus, A like that. So there's different ways of rating debts. So we are not going to talk about how debts are rated in this case. But what is important is to know how debt rating is going to affect the cost of capital. I mean, the cost of debt. That's what is important in this part. How the way the debt is rated, how is it going to affect the cost of debt? We know that the higher the risk, the higher the cost, or the higher the return that is going to be asked. So when we have a debt rating, for example, our cost of debt will be equal to a risk-free rate plus the spread into 1 minus T. In where the debt is rated, if the debt is rated, that is how you are going to determine the cost of debt. So I can give you a simple case and you tell me, this one is not very complicated. The current rating of company X is debt is AAA. With subordinate debts, debt having a maturity period of 5 years.
What is that debt?
Huh? That's the senior subordinate debt. It's like a senior debt.
No, not understood. You write debt as a...
Hey, sorry, as a tariff. Okay. With a maturity period of 5 years. The company is evaluating issuing a junior debt under junior debt, which is pari. Oh, okay, let's leave this. The junior debt this will lead to a decrease in the rating of the debt to AA. What is wrong?
Excuse me.
Yes,
Is this word decreased or decreased?
decrease, eh?
This will lead to this.
The decrease. Please mute.
ariko mwarimu ibi bintu urabikura mu mutwe cyangwa you are writing it from somewhere?
Huh?
ntabwo uzi ko agira igitabo mu mutwe man.
Why, sir? So let's look at this. Let's look at this example. So now that's what we are saying now.
Excuse me.
Yes, please.
Before you proceed, if you say with a subordinate debt, you mean it is a compound?
A senior debt.
Oh.
So let's finish this. Probably we need to finish cost of capital. When we meet Mulbro again, we do capital structure, and then we can start investment. Investment, I think, will take us. So please mute if you are not asking a question.
David Mutabazi.
So let's look at this. Now, what is our data we have? Because we are looking at before and after. So the cost of debt before What's the cost of debt before? I have a risk-free rate. That's the data we have. We have a risk-free rate, which is 10%, 9%. I have a T, which is 30%, and I have a spread of 8.5%. So from there, I can look at my formula. What is going to be the cost of the debt? Going to be risk-free plus my spread into 1 minus T. So if we substitute, I'll have 0.09 plus our spread is 0.085 into 1 minus 0.3. And what do you get with your calculator?
It's 14.95.
14.95%. So that's going to be the cost after, before the debt is. So what about the cost after the issue of another debt? Still, I think the formula is the same. Our KD is that. So this one is the same, but this one is changing.
Excuse me.
Yes.
Is that 14.9 or is 12.25?
I don't know. I don't have a calculator, sir. I'm only hearing what you are telling me.
Okay.
Check the calculator. Is it correct or not correct? So what about after the issue of another debt?
Which one?
The junior debt.
Maybe we don't understand the theory behind.
Before issuing the debt, this is the rating. Maybe I didn't explain this.
Mm-hmm.
Before the debt, this was the current debt that you have, and it was rated the AAA.
Mm-hmm.
Okay?
Yes.
The one which is a subordinate debt. Now, you have issued another junior debt. By issuing a junior debt, your rating is reducing to AA.
Okay.
And then the spread becomes 12.4. This is the current spread. This is the new spread after issuing new debt. Yes.
Okay.
What are you getting? So that is how we can incorporate credit rating. So I don't know if you have a question on that. Yes, please.
Yes, sir.
Mm.
Now the maturity period is 5 years, and I think the spread should be within those periods.
Yeah.
Why have you decided to consider only 2?
To what?
Two spread, can I call it 2 spreads, like 8.5, 12.4?
Yeah, but by increasing because as you are increasing the debt, you are increasing the risk to the other one. So yes, the maturity may be the same, but because of the high gearing, the risk becomes different, the spread becomes different. Nakusubije se?
Yes, sir. Yes, understood.
Okay. So which factors that influencing debt rating? Factors which influence debt rating. Number one is what we have already talked about. Probability of default. Probability of default. And we have already said the higher the default, the higher the risk, or the higher the spread. I think we have talked about this. The higher the probability of default, the higher the risks, and the lower the rating. So if you have a debt with a high probability of default, I have not put that word. The higher the probability of default, maybe you can add that. The higher the risks, wow. The higher the risks, and the lower the rating. That is number one. Number two is maturity period. Maturity period. The longer the maturity period, the higher the spread, the risk. If you have a debt that is maturing in 2 years and another debt which matures in 5 years, a debt which matures in 2 years will have a lower risk compared to a debt that is maturing in 5 years. So the longer the maturity period, the higher the risks, and the lower the rating. So if you have a debt that has got a high risk, I mean a longer maturity period, it will be having a higher risk compared to debt with a low maturity period. 3, level of gearing. Level of gearing. So if you have a high level of gearing, you are considered to be high risk. If the company has got a very high level of gearing, so the higher the level of gearing, the level of gearing, the higher the risks, and vice versa. So if you have a high level of gearing, you have a high level of risks, and if you have a low level of gearing, you have low risks. So it means you are going to be rated high if you have that. Stability of the company's cash flow. With the stable cash flows, the company is able to pay the debt. If the company has got a stable cash flows, it has the capacity, it is recognized as the company that has got of the company's cash flow. If the cash flow of the company is stable, the company has the capacity to pay or has the ability to pay the debt. If you don't have enough stability in the cash flows, so in that case, the one which has got stable cash flows is going to be rated low. It's not high risk. The one which is not stable, which has no stable cash flows, it's rated high because there are chances that you may not be able to pay. So the company with stable cash flows is considered to have low risk, and vice versa, I think.
Question, sir.
Yes.
I'm asking myself, I'm going through these factors. For example, if we say that the maturity period, the longer the maturity period, the higher the risks. And I'm asking myself, why should it be rated at lower rate?
Because it has a high, because as you are going into the future, the probability of default increases. The risk becomes high for someone to default as you go into. That's why you consider that one to be high risk. If it is high risk, it's going to be rated lower. So lower rating, it means if the debt is rated lower, it means that debt is high risk.
So why would it be rated lower? Would it be maybe
because they are seeing as if there are chances that you may not be able to pay. The company may lose the money.
Okay.
Yeah.
Thank you.
look at the political instability, political conditions. If the political conditions are not stable, these companies are considered to be of high risk if they are not, the political conditions are not stable. Are not stable. The debt is considered to be of high risk. So if you are in a country where there is political instability, so that raising a debt, that debt is going to be considered as it has a high risk. So in that case, that debt is going to be considered to be low. It's going to be rated lower because it is risky. But if the stability, there's political stability, plus other factors, in that case, they may. You can talk about the GDP and employment. GDP growth. So with high GDP growth, in that case, we consider that the risks are not high. With the high GDP growth, the debt is considered to be of low risk because there is a lot of economic activities, you can be able to pay the debt and vice versa. So these are some of the factors which may influence.
Why?
Huh?
There is little economic activities.
Yeah, there is high economic activities because if there is a high GDP growth is reflected in the economic activities. Economic activities for business, it is profit. So another, we talked about cost of retained earning, but we said the cost of retained earning is similar to the cost of common stock because they all the equity holders. Cost of retained earnings. KR. So in that case, the cost is similar to the cost of who? So the cost of retained earnings is similar to the cost of common stock. Except for retained earnings, there are no flotation. So the cost of retained earnings is similar to the cost of common stock, except that for retained earnings, we don't have what? We don't have flotation costs, but the cost is the same. The way you compute the cost for retained earnings is the same way you're going to compute for, or we consider to be the same cost. That's why in some cases it is ignored because it is the same cost for the ordinary shareholders. So in case it is asked, or in case you need to calculate, it is KR equal to, because that is D1 over PO then plus G. So it's the same cost that you compute for retained earnings. So that is the cost of each source that we have looked at, where we started with the cost of common stock, we came to cost of preference shares, we have come to cost of debt, we have looked at the cost of each debt, the different debts that we have looked at, and now we have looked at the cost of retained earnings. So our next
Why do we use D1?
Because it's also from the dividend. The dividend they are going to get, it's the same cost, you only remove the flotation costs.
No, my question is, why not D0?
Eh?
Why not D0?
Why not the zero? It's because we are looking at, because we are at the end of year one, isn't it?
Yeah. Yes.
So what we are going to forego the expected dividend that we may not get to allow the business to invest. Is it contradicting?
Not contradicting, not understandable.
Huh?
Not understandable.
How did we get the cost of ordinary common stock?
D1 over PO.
Why did we use D1? If we got that one.
Because it was under the assumption that is the dividend for the next year.
Yes. And for common stock?
That is for common stock, what we saw last time.
And now we are on retained earnings. Our retained earnings, which we are foregoing to allow the company to invest. Isn't it? You are foregoing the retained earnings and you are allowing the company to use the retained earnings to invest. Which should be, you should have been given that dividend. You should have been given a dividend.
D0.
D0. But which is expected to grow as your retained earnings are growing. Isn't it? As the retained earnings are growing, you expect that dividend also to grow. So it means you will be having a D1, not a D0. Probably, maybe, I will see, but it is what you expect to pay to the ordinary shareholders.
Okay, sorry, guys.
Huh? Is it confusing?
It's not clear enough.
Not, sir.
Now, what do we pay for why do we calculate this cost? It is opportunity cost, isn't it? Isn't it?
Yes, we understand that we
Awesome.
Yes,
opportunity costs.
Yes, please.
How it is the opportunity cost?
Because if you are to invest using retained earnings, it means you're not going to give a dividend to the shareholders.
Yes.
The shareholders are foregoing that dividend they should have got, which is the expected dividend.
Meaning that the cost of retained earnings is the alternative for going to the dividends.
The dividend.
Okay.
Because the shareholders are allowing you to use the retained earnings to invest rather than getting the dividend. So it's an opportunity cost. But what I think Joseph is saying is that there is no growth. And we are saying there is a growth because you're expecting that the retained earnings would be growing and you will be growing. So another part that we want to talk about under this, as we are summarizing this chapter, weighted average cost of capital. Weighted average cost of capital. So the weighted average cost of capital, or what we abbreviate as our WACC, I think. It is the average cost of capital of all sources used to finance the business activities. The cost of all sources which you have used to finance the business activities, we recognize them into our weighted average cost of capital. So how do you get WACC? Different ways to compute WACC. The general one that we always use is that, but which is not very much, because sometimes it may make it under assume. It is KE times WE or VE, KE times VE plus VD times KD into 1 minus T. This is VE plus VD. And this one VE plus VD.
Where is the value of preference share?
And that's what we are going to look at again. But preference share, sometimes we consider it under equity, under debt. So where KE is the yes, please.
You can correct on VE, the up one, which is
VD, sorry, here.
Yeah.
Cost of equity VE is market value. Of equity KD is cost of debt. VD, value of debt. I think that's all. T is our tax. That is one way to compute. Another way to compute is to get our wachacha equal to KE times WE plus KP WP plus KD WD plus KR WR sometime, where WE, I think KE to WE is the WE, WP, WD, and WR are weight of equity, preference, debt, and retained earnings, respectively, which you can get from market value, which are equal to, or the weight of each source, weight of each source, maybe if I can put like this, will be equal to the market value of the source divided by the total market value of all sources. That's how you're going to get your weight. If I don't use that, I can just get.
Excuse sir.
Yes, please.
Can you first correct if where we the
Where?
It is a weight of equity, not a weight if equity.
Okay, weights. Okay. Weights of. Okay, thank you. So that is how we compute the cost of each source of finance. I don't know if you have a question on that.
sir, before I would like to know how can someone know or comes to understand which type of formula are going to use.
This one is the simplest, I think, to use. This one. It's the simplest to use, but you all get the same answer. But this one, I think, is the simplest. There's no that you should be speaking on this. This one is the simplest formula to use. There is another one that you may look at, which you are going to. So I want before, I don't know if you shall look at an example, as if the sugar is starting to reduce. Wait. I want to talk about this one briefly. Marginal cost of capital. And you can say that it is the cost of capital for the additional sources of funds that is used to invest. So if I'm operating and I'm using, currently I have a cost of capital, but I'm issuing new additional sources of capital. The cost, the total or the weighted average cost of capital after considering the new additional sources of capital is what we call the marginal cost of capital.
This marginal cost of capital is related to Wachacha.
It's related to Wachacha, but now you are considering the additional sources you are making. For example, if I'm financing a business with 100 million and I'm going to issue another 20 million, what will be the cost? Is the cost going to remain the same?
Come again on the example.
I'm saying I've been financing a business using 100 million, and my cost may be equity. The cost is 20%. Now I'm financing. I'm issuing additional cost, additional equity. Will the cost going to remain the same 20%?
No.
The cost will change.
Yes.
After issuing additional sources. Isn't it?
Yes.
So that cost after issuing additional sources is what we refer to as the marginal cost of capital.
Okay.
Yes. I was planning to look at a simple example before we look at the past paper, which I've already looked at, which I've already prepared. I wanted to ask example. Maybe you will do it. Example on this. That summarizing this.
Is it for long time or it is for long term?
Long time.
Long time investment.
confused.
You are confused with that sentence. Company
I've been
X.
operating in the business for a long time. That is a comma. Investing, maybe.
Investing, yes.
In different projects.
Okay. Scroll up. Can scroll up, little bit.
Change something small. Let me remove this.
Was it doctor?
Mm.
Was it?
I'm still writing a question. I don't know if you have followed the question. The way I was trying to think. So this is a question, please. I want you to try. Try this question. This is company X. Has been operating in a business for a long time. Investment in a different project, or investing in a different project. Investing in a different projects. The summary statement of financial position. Maybe we didn't put the year, but the year is 31st December 2023. So that is the financial position that we have. Then we have this additional information. We can go through and see if there is no mistake. The company gave its first dividend 2015 of 35. The current dividend, that's in the year 2023, is 44. We did expect to continue growing. The current price of ordinary share is 240. So we can be able to get that data. The preference shareholders have a fixed dividend of 10%. The preference shares are currently trading at 150 francs per share. Redeemable debenture are currently trading at 980 francs each. The redeemable is currently trading at this. It has a maturity period of 5 years, and it will be redeemed at a premium of 20%. Our corporate tax is that. Then number 6, the company is evaluating investing in a new carbon reducing equipment. This will require additional investment. Oh, it's written require additional investment. It's written twice. Additional investment of 250 million, which will be raised as 100 million will be from common stock and 150 million using a mortgage loan. The cost of common stock is going to increase by 3%, while the bank loan will increase by 4%. So what is required? Compute the cost of each source of finance before the new issue and the wachacha. Then compute the marginal cost of capital. So, any questions on that?
Yeah, for computing the marginal cost of capital, shall we consider the additional information of number 6?
Number 6, yes.
That is the importance of now adding that additional number 6.
Yes, please.
Okay.
Any other question, comrades? Any question, friends? We are closing, I think, for today. Our next class is Wednesday, isn't it?
Yeah, it will be Wednesday.
It will be Wednesday. Will you have finished this question? I think we will have done it. We look at the past paper only.
Yeah.
Have you found are you seeing any challenge in the question? Such that when we meet, we only look at the past papers. This one, you will have done it. Okay, we shall first do it maybe, and then we can continue with the past paper probably. Okay, let's stop here and then we meet on Wednesday evening at 6. Isn't it? Yeah.
To finish to copy.
I'm going to share the Excel, the PowerPoint. I mean the PDF or the Excel. Is it okay? I'm going to share in the group. Yes?
No, share it on call. I am a demo easy.
Yeah.
Sama.